Welcome to this IG Live special covering the Bank of England interest rate decision in 5 minutes' time. We are looking for primarily guidance on just what the voting was around this decision today, because last time we saw that 7-2 vote to leave interest rates on hold, but the surprise was those two votes to drop interest rates. And it's in that context that we've got this decision being made in today's trade. Since then, of course, we've had economic data which shows that inflation remains well below the 2% target, but jobs are still being created. But they're being created without any sort of inflation excuse me a minute, my apologies, in the average earnings, which makes all the difference, because it means then the environment is not one of inflation. So inflation is not coming through. So that's a problem that the Bank of England has. Does it now therefore go on a loosening trail into next year to give a better opportunity for the economy to start expanding again? Since the last meeting as well, there's been more political clarity come through. So we've got interest rates at 0.75%. We've got the QE bond buying programme, which has been left now for some number of years at 435 billion sterling, plus also the 10 billion that's out there for those corporate bond purchases, which is still part on the Bank of England balance sheet. It's a quick check on where we are in terms of the trade at the moment on the FTSE 100. We're at 75.62. Money continues to go into this index, as indeed is the case as well for the mid-cap 250. We're up today. We've seen record highs this index. In fact, that was the first trade this week was back up at new records, almost at the 22,000 level for the FTSE 250. Since then, been a little bit of a pullback, but nonetheless, broadly speaking, holding on to the gains that we made in the wake of the election last week. I've got my voice back, got everything back on. We're flowing through. Josh is with us now with some more analysis. And putting all this together, it sets us up neatly for the headline to see whether or not the Bank of England does have any sort of change of opinion.
Yeah, certainly. Look, we have seen change since the last meeting. That's the crucial thing. And how is the Bank of England going to respond to this? By and large, the expectation is that the next move looks like it could be a cut. But the question mark is, why would that cut happen, right? So in terms of the economic indicators that we've seen over the past month, they haven't necessarily been great. And that really is alluding to the fact that by and large, the economy has been slowing down, with a lot of people stopping taking any major investment decisions because of the fact that we had the election. So I sort of feel like any of the numbers that you're going to be looking at this month, you can pretty much disregard unless it's going to be relating to the post-election period. A few things I wanted to show to you guys. This is the Reuters platform. You can see here on the bottom left section, we can see the forthcoming meetings. And you can see this current meeting expectations of a cut, 3.1%, no change, 96.9. So by and large, everyone expects to see a no change on this occasion. And bear in mind also that these kind of indicators, these market indicators and expectations, are generally factored into thinking at the Bank of England as well. So you can look going forward, and the forthcoming meetings, you can see the one element of that is growing is the cut element. And that really is going to shift dependent on the outlook potentially today, what the voting could look like today. You can see also in terms of the breakdown in some of the members, we can see, of course, we had those two members far to the left for that 7-2 vote. Are we going to see that shift, potentially see it go 6-3? That's the kind of thing that could move the markets and start seeing some devaluation of the pound. Certainly, that is something that we have been seeing quite a lot of so far this week. It's been a very interesting week because, of course, we saw that initial break towards the upside on the resolution of the election. But since the exit poll, we've pretty much seen this market move lower. And certainly that has ramped up because of the fact that we've seen, of course, Boris Johnson alluding to the fact that he's actually willing to sign it into law that there's not going to be an extension to the transitional period. That has certainly cut the honeymoon short. And we've seen this move towards a downside. The key thing here is, are we going to break below this key 130.50 mark? And that really is the major line in the sand when we're looking at cable today.
Okay, all right, Josh, thanks so much indeed. Sets us up neatly going into this decision at the top of the hour, just a matter of 20 seconds or so away. So we are expecting things to remain as they were last month, but as I said, the big question is about those two that voted to cut interest rates at the last meeting. And as I said, the economic environment for this is at the moment out for report, because we've got, as I said, that political vision that we've got now. Is that going to ease the way that we see the Bank of England look into 20 with a slightly clearer vision. So we have the same spread that we had before, 7.2 to leave interest rates on hold, and there is no change on QE, of course, is what we were expecting, and interest rates are at 0.75%. So that's where we are in terms of the numbers themselves. Josh, I just want to quickly catch up with you if I can to see whether or not there's any move on the currency markets, because I think the message is unchanged. The situation is as it was, and we've got a little bit of money coming out of sterling, but not in the context too much, maybe.
Yeah, I mean, you're seeing initial selling now starting to recover, so we're pretty much back to where we were at the moment. But certainly, if we look out, so we were talking about that 130.50 mark. That has pretty much been respected thus far. We saw it drop back into that key support level. Now starting to see the bulls gain into prominence again. Let's take it back onto the 4-hour chart and show you that by and large, that key level, 130.50, held, is touched. And does this form a potential area for this market to start bottoming out? We don't necessarily know. I won't necessarily say that this meeting is going to be the spark that lights up the pound once more. But certainly, really, the thing that I needed to see to negate this bullish trend that has been in play recently is a break below 130.50. We've now touched it and started to move higher again. Let's get back onto that 1 minute chart just to see exactly how we're trading. So, seeing a decent bit of volatility over the short term. Just wanted to also bring up the euro sterling chart. I think this is a really fascinating chart as well. Let's go on to the wider context. We can see here on, let's say, the daily time frame. Actually, it was the weekly I was looking at. What we can see here is this massive decline lead up to the election. Of course, much like the chart for cable, we've been seeing sterling weakness. On this occasion, that is reflected in upside for euro sterling. But we can also see that this has seemingly bottomed out at 83.05. That is a crucial historical level of support, supported in December 2016, alongside April 2017. So we've seen this really long-standing move towards the downside, now seeing this bullish engulfing pattern. Could this be the beginning of a recovery for the likes of euro sterling? Certainly the key thing to be looking out for, I think, in this time frame is, do we get that break up through the 20 mark on the stochastics to really signal that shift in terms of momentum in favour of euro sterling?
It's interesting, actually, looking at some of these statements that we've got. The Bank of England says if global growth fails to stabilise or Brexit uncertainties remain entrenched, monetary policy may need to reinforce an expected UK recovery. But he goes on to say, if the risks do not materialise, there is the opportunity to take rates in the opposite direction. So basically what they're doing is it's a balanced report out here, which is showing that there are a sufficient amount of arguments out there to suggest that they could well be faced with a need to tighten policy next year. But on the flip side, if it doesn't develop, then it could well be that we might end up seeing interest rate cuts. The benefit that we've got, of course, at the Bank of England over the European Central Bank is that interest rates are and have been positive. We saw the Riksbank this morning go from a negative to a positive, or negative to flat interest rate environment. I think there are 6 central banks meeting today. We've got the Bank of Mexico a little bit later on today. But the Riksbank is just one of a few central banks that are beginning to tighten, which is interesting. They're outside the Eurozone. The Eurozone seems to have a problem that is entrenched, and the Eurozone continues to pay. They've got the QE program that's been started up again. So they are continuing to loosen. We now know that there is a strategy from the new chief at the European Central Bank to start to encourage nations to try and ease their fiscal policy, which is all going to help the Eurozone. But the Bank of England still is unsure about the direction in terms of where it's going to go in terms of interest rates. So 2020 is an unknown factor.
Yeah, firmly sitting on the fence, basically saying we could move in either direction. Certainly in terms of market expectations, they only expect them to move in one way. And I guess if you look at what Boris Johnson's been doing in terms of laying out this very firm timeline in terms of those trade talks, there is an idea that if we did see a rate rise, that is done ahead of what could be a messy exit from the EU, and in which case we'd have to actually see them cut in the future. But one thing's for certain, we're going to have to be following these economic data points very closely to see exactly how the economy is reacting to that election result. Are we going to start seeing an uptick in terms of the numbers? And crucially, how is that inflation reading going? Because, okay, 1.5%, not necessarily too close to that 2% mark in terms of headline number. But bear in mind that we don't necessarily have any sort of impact from monetary policy on things like energy prices. So the core reading up to 1.7%, a lot closer to that target. So certainly that, of course, if we see it move any closer to that 2% target, supposedly that's their primary remit, really, then it wouldn't necessarily be too much of a reason for them to start cutting interest rates any further. So certainly I think that the likes of the pound and some of the UK-related markets are going to be very volatile or sensitive to UK data going forward, in particular likes of inflation.
And of course, the other thing they don't know is yet they don't know precisely what the government is going to do in terms of its strategy towards taxation. We've heard a lot about the fact that Boris Johnson wants to cut tax, wants to allow more money to flow around the economy. And I guess until we know more about that, it's going to be difficult to know precisely where the Bank of England does move. But on balance, were you surprised to see that there are still 2 of the voting members that wanted to cut interest rates, given that we do have political visibility? There has been evidence of more money coming into the market. We know that from anecdotal evidence from the RICS about house prices. We know as well that there are some machinery companies around the country that have said publicly since Thursday last week they're beginning to get orders coming through again. There's evidence to suggest that things are now beginning to at least catch up with the stagnation that the economy's had because of the political impasse. But I'm surprised to some degree that we've still got 2 voting members quite clearly voting to cut interest rates, which I think, given the environment, it surprises me.
Yeah, I guess there's 2 ways of dealing with it, right, or looking at it. Ultimately, the Bank of England and all other central banks should really be trying to deal with what's happening with the economy at the moment. That's obviously very measurable. If you look at the numbers that we've been seeing for this month, they haven't been great. And certainly we've been seeing a sharp deterioration. Your services PMI, your manufacturing PMI, some of the jobs numbers, the earning growth, the lot. But you also have to take it with a pinch of salt because of what's happening with the UK economy at the moment. We know that there has been a huge sort of hold back in terms of the investment, both on the consumption side from people on the streets and not necessarily knowing what position we're going to be in. Are we going to have a Jeremy Corbyn-led government? What would that mean for them? And on the side of businesses, the same kind of thing. We could be seeing a ramp up in terms of taxation. So they would surely know that there should be a reaction in a month ahead, and it probably makes more sense rather than to jump the gun and think, right, we have to cut rates right now. It probably makes sense to hold off and see exactly where we stand in a month or 2's time. So, yeah, it doesn't necessarily make sense to me, and almost feels like they're voting to cut rates in the sense of wanting to have some sort of voice, but knowing that that's probably not necessarily going to happen,
Just look up, if you can, at the FTSE 250, because I think that's important. The FTSE 100 as well, by comparison. Money does tend to be going into these markets. It seems like there has been this relative underperformance for the major benchmarks here in the UK against other indices because of the political problems or the impasse, the stagnation we've had. I don't know quite how you go about trading these markets, but what have you got there? It's the FTSE 250.
Yeah, so this is the 250. I mean, look, if we work our way in, you can see weekly time frame, we broke through that previous peak on the election result. Since then, we've seen some upside, but started flagging a little bit. And for me, I think that until we break below this 21467, which of course is the low of the week, I do think there is a good opportunity that this could be a sort of basing pattern. You can see we're vaguely respecting that 76.4 Fibonacci retracement. So there is a good chance that we could now start to surge back up to 219.35. Now, in terms of a breakout level, you're going to look at this peak here, which is pretty much the sort of top end of this gap. We gap down into this and pretty much respected as 21715 level. So if we break through that level, there is a good chance we're going to continue with this recent uptrend. I think the interesting thing also is with the likes of the FTSE 100, bear in mind we've of course got this whole story about FTSE 100 not doing well at times when we're seeing sterling strength, and the expectation of sterling strength under a Tory majority like we saw would of course drag on the likes of the FTSE 100. But bear in mind, the FTSE 100 isn't all made up of international companies that are bringing earnings into the country, and therefore a strong pound is to the detriment of those companies. We also have more domestically focused firms. So what we're seeing at the moment is a double whammy. You're seeing the domestically focused firms performing particularly well because of this Conservative majority and what it might mean for them going forward, the potential for the UK economy to pick up. But we're also seeing the upside associated with that weakness in the pound. So that double whammy really seeing this outperformance of the FTSE 100 at the moment. We can see on a weekly time frame that we still do create these lower highs. We broke through the 7446 mark, but now currently trading around about the 76.4 Fibonacci retracement. So certainly how we respond to this level is going to be key, because if we continue to move towards the upside and essentially negate this resistance level, you're going to be looking towards that 7730 peak that we had around about the back end of July for the FTSE 100.
Okay, all right, Josh, thanks so much indeed. Time has caught up with us. We must move on. But the broad message is from the Bank of England that there is no change to the message that went in to the election last week. At their last meeting, they were 7-2 split. That's exactly what we've got this time around. 0.75% is where interest rates are. No change, of course, to the QE. There's no other documentation that's been released with this report today. We've got to wait until February to get the next update, the quarterly update, when the Bank of England will have a better idea as to the direction of inflation and growth. And until then, the bank clearly wants to keep policy and the general message the same. My thanks to Josh leading us through these markets. We're back at 4 o'clock this afternoon, where we will guide you through the calendar for tomorrow. And I'll be back tomorrow morning at 7:30. Hope you can join me then for Friday morning's early morning call.